Hello and welcome. If you're involved with a Canadian business, you know that major assets, things like vehicles, equipment, buildings, they don't last forever. So the big question is, how do you account for that loss in value for tax purposes? Well, the answer lies in Canada's Capital Cost Allowance system, or CCA. Getting a firm grip on how this works is absolutely fundamental to proper tax planning, and that's exactly what we're going to unpack today.
Just a quick note, this presentation was prepared by Dr. Samir Al-Rishani with AI support.
So, here's our roadmap. We're going to follow the entire life cycle of a business asset. First, we'll nail down the core calculation, the engine of the whole system. Then, we'll get into the timing, specifically when you can actually start claiming these deductions. After that, we'll look at what happens when you sell or dispose of an asset, which can lead to 3 different outcomes, something called recapture, a terminal loss, or even a capital gain.
All right, let's jump right in. We have to start here, because honestly, everything else we're going to talk about today builds on this one foundational concept, the core CCA calculation. Let's make sure we have this down cold.
Think about it like this. When your business buys a new delivery truck, it would be incorrect to deduct the entire cost in that 1 year, right? Because that truck is going to help you earn income for many years to come. So the CCA system is simply a structured way to spread that cost out, letting you deduct a portion of it each year as the asset gets older and loses value.
Now, this table you see here, this is the heart of the whole process. It all starts with your Undepreciated Capital Cost, or UCC. That's just the value you had left over from the previous year. To that, you add any new assets you bought during the year. Then, and this is key, you subtract the value of anything you sold. That gives you the new balance that you'll use to calculate your deduction for this year. And finally, whatever's left over at the end becomes the starting point for next year. It's a continuous cycle. You know, theory is fine, but seeing it in action makes all the difference. So, let's create our running example. We'll imagine a business that goes out and buys $10,000 worth of new computer equipment. For tax purposes, this type of asset is in Class 50, and that class comes with a CCA rate of 55%.
So how did we arrive at this number for the first year's deduction? You might think, easy, it's just 55% of $10,000. But hold on. There's a special rule for the first year an asset is purchased. It's called the half-year rule, and it says that in the year of purchase, you can only claim CCA on half of the asset's cost. So the real calculation is $10,000 divided by 2, which is $5,000. Then you take 55% of that $5,000, and that's how we get our first year deduction, $2,750.
Okay, so we've bought the equipment, we know about the half-year rule. Can we start deducting right away? Well, not so fast. The timing of your first claim is governed by another very important rule.
And that's the available for use rule. It's pretty intuitive, actually. It just means that you can't start claiming depreciation until the asset is actually ready to do its job and help you earn income. So, if you buy a big piece of machinery in December, but it doesn't get delivered and installed until February of the next year, well, you can't start claiming CCA until that second year. The purchase date alone isn't enough. Now, like with many tax rules, there are some exceptions. For really big assets, like a building, the rules are a bit more flexible. You can start claiming CCA on the earlier of 2 dates, either when you're using substantially all of the building or at the beginning of the second tax year after you acquired it, even if construction isn't 100% complete. It provides a bit of a backstop.
All right, sooner or later, an asset's useful life in your business comes to an end. You might sell it, trade it in, or just scrap it. This event is called a disposition, and it triggers its own very specific set of rules that have a direct impact on your UCC balance.
And here is the single most important rule of dispositions. When you sell an asset, the amount you have to subtract from your UCC balance is the lesser of 2 numbers, what you sold it for or what you originally paid for it. Why? Well, this rule is there to cap the deduction. Even if an asset has appreciated and you sell it for a huge profit, the reduction to your UCC can't be more than its original cost. We'll see exactly why that cap is so important in just a moment.
So once you apply that lesser of rule, the UCC balance is going to change. And that change can lead to one of 2 immediate tax consequences. You'll either have what's called a recapture of CCA or a terminal loss.
This table lays it out perfectly. They're really just 2 sides of the same coin. A recapture happens if a disposition makes your UCC balance go negative. This basically means you've claimed too much depreciation over the years, and you have to add that amount back to your income. A terminal loss is the exact opposite.
It happens when you sell the last asset in a class and you still have a positive UCC balance, meaning you didn't claim enough depreciation. In that case, you can deduct the entire remaining balance from your income.
Let's focus on recapture for a second. The easiest way to think about it is that the tax system is basically saying, hey, wait a minute, looking back, it turns out you depreciated this asset a bit too aggressively. That negative UCC balance represents those excess deductions, and the government recaptures them by making you include that amount as income in the year of the sale.
And on the flip side, you have the terminal loss. This is your one last chance to write off any remaining undepreciated cost. But, and this is a critical condition, you can only claim a terminal loss when there are absolutely zero assets left in that particular class. If you still have even one computer left in class 50, you can't claim the loss. You just have to keep depreciating that remaining positive balance.
Okay, so we've covered recapture and terminal loss. But there is a third possible outcome when you sell an asset. What happens if the asset didn't lose value, but actually went up in value, and you sell it for more than you originally paid for it?
This is the bright line test for a capital gain on depreciable property. It is not enough for the selling price to be higher than your UCC balance. Remember, that situation often just leads to recapture. To have a capital gain, the proceeds from the sale must actually exceed the historical original cost of that asset. Now, when you sell for profit like this, the tax system splits that profit into two separate pieces. The first piece, which is the difference between the sale price and the original cost, is treated as recapture, and it gets added to your regular business income. The second piece, the amount above the original cost, that's your capital gain. And this is important because capital gains are typically taxed at a more favorable rate than regular income.
And this is a really vital point of distinction that often trips people up. For depreciable property that's part of the CCA system, you generally do not have capital losses. This system is designed to account for losses through that terminal loss rule we just discussed. If you sell an asset for less than its cost, the system self-corrects through the UCC adjustments, not through a capital loss.
So, let's just boil this all down to the essentials. First, everything revolves around that undepreciated capital cost, or UCC calculation. Second, when you sell an asset, it's going to trigger one of only three main tax events: recapture, which gets added to your income, a terminal loss, which you get to deduct, or a capital gain, but only if you sell for more than what you originally paid. If you can keep those three outcomes straight, you've really mastered the core logic of the CCA system.
And that leaves us with a final question to think about. Now that you have a firm grasp of these mechanics, the half-year rule on new purchases, and the very different income effects of a disposition, how could a savvy business owner or accountant strategically time their purchases and sales throughout the year to manage and optimize their overall tax liability? That right there is where understanding this system moves from just academic theory into powerful practical strategy.